Good morning, ladies and gentlemen. This is Clueless Trading Frank. Thank you for listening to this pre-market AM broadcast. It is approximately 8:51 a.m. on a Monday morning, June 13th, 2016. I wanted to thank every single member of the Clueless Trading Club, as well as free trial members for their continued support. These are difficult and volatile markets. Traders tend to miss out on large retracement rallies, as we have seen repeatedly. And at the same time, when we get corrective pullbacks, they tend to also miss out on tactical trades, both on the long side and the short side. What happened on Friday was a mini black swan event, as I mentioned in my previous video cast. It was unprecedented on the currency markets, as well as on the specifically on the currency markets, and this Brexit fear that the UK, the United Kingdom, England might be leaving the euro. Well, it doesn't happen in one day. Let's put it this way. The logistics is they're getting a referendum, but the referendum speaks a lot. It's not like they're leaving the euro, starting on Tuesday. Starting June 23rd. But the reality of the thing is that it spreads like wildfire, and it's really an emotional contagion of what might happen. Saying all that, a word of caution. The world is not ending tomorrow. So we have to keep our heads straight. And despite a tactical pullback that we saw on Friday, which might continue a little bit further down, as I clearly mentioned in my previous broadcast, and I'll show this here again, and it might get uglier, more uglier than what we think, we have to be prepared. Tactical trading is the key. I'd like to congratulate personally every single LinkedIn holder, a recommendation that I've been suggesting for weeks now, shown in the form of gap fill entries, gap fill charts, bought at the lows on the crash, all kinds of good stuff. Today got bought out for a 50% premium, almost 48% premium, at $196. Stock is up 63 plus points. And we also have a sympathy move on Twitter, which I believe is going to be the next takeover target from these very depressed levels. Don't know when. We never know when. But that's the reason why we have to have certain tactical positions in it. Is up about 4%. And we move on. Like to remind everyone that in one of my previous video casts, by the way, in the background, as you can clearly see, you're seeing the E-minis, the pre-market. We are down about 7 points, and I'm going to go over that in a quick second. This is a 15-minute broadcast. I'd like to remind everyone that if you listen to my previous video cast, I told you that the middle of the month, the 15th, give or take a couple of trading days, plus minus, is probably one of the most turbulent times you're going to find. And that normally happens in a lot of cases in every month, but this month, it is obviously exaggerated because of a critical Fed meeting that's coming up. The rate announcement is going to be on Wednesday. There's a lot of fear on what might be, what the Fed's going to do, whether they're going to raise rates in the face of European instability. China basically, despite some strong numbers on the industrial production side, we got a big sell-off in China. The Nikkei fell hard on the fact that the yen is strengthening versus the US dollar, which means a risk-off non-carry trade that I've explained several times. So there's a confluence of factors going on, and on top of that, you have had a parade of hardcore, very dogmatic, and if you look at historically speaking, very wrong predictors of the market, such as George Soros, somebody who manipulates the market quite a bit, in my opinion, with his words, Carl Icahn, for his own book. Everyone does this stuff for their own book. George Soros has been a bear throughout his whole entire trading career overall. If you read back and you can Google it, understand it. And then you have Bill Gross, who's the worst stock market predictor ever. Yet they're making tons of money. The fact that the bond prices have been rallying as money flows into the safe havens, in the form of the TNX, which is the 10-year government bond. Show you right now, and I've shown those before. And if you look at the daily chart on the TNX, plunging bond yields means rapidly rising bond prices, and you can see where we are right now. At the bottom of the market, before we started this year's rally in February, bond yields were at 1.5657%. Is it possible we get there? Chart says yes. Is it possible that we hold the upper end of this reversal candle? And remember, this is the bond yields, okay? For people who are a little bit new on this, on understanding it. You move the decimal point to the left, it's 1.642%. We closed at around 1.625% right here. So at this point, if you look at the upper end of this reversal candle that we saw on the 11th of February, which was one of the most powerful buying signals and correlated on the S&P on the other side, I feel that if we get towards the 1.5% level, or even from this level, we might get a powerful retracement rally. There is technical damage somewhat on the overall charts, on the daily charts, on the markets. The midterm charts are showing deep oversold conditions. One of the things that I've added is the McClellan oscillator for everyone to see. I don't really go by the McClellan oscillator when it comes to looking at the credit markets, but the upper end of the candlestick is pretty much where we are right now. So let's see what happens. Plunging bond yields, rush of billions and billions of dollars into the safe haven, into government bonds, away from the risk markets, which are basically the equity markets, the stock markets, causes institutional margin calls in a large way. If somebody was short the bond and then the bond prices rallied against them, they get monster margin calls, institutional margin calls, and those are huge. All are happening underneath the surface. The way you look at it is you have the stock market here, which is basically, if this is the C, underneath the market is the credit market, which acts in mysterious ways in many cases. Currencies, oil, all kinds of stuff, political thing attack the credit market in a big way. The fact that the German bond hit almost zero, okay, and talk of negative interest rates in Europe, coming into the U.S. shores, which in my opinion is never going to happen in the U.S. And if it does happen, negative interest rates, or even comes close to it, I can assure you, you can stay short for months in a row. That's my feeling, because that's the worst thing the U.S. could ever do, okay? Because that's basically saying that we have no growth power, and I don't believe that. I think U.S. companies are the finest in the world, and we are, in my opinion, one of the strongest economies, like we say, at this point, given the fact that I've always said we are the best house in a bad neighborhood, okay, the USA. So above the waves is basically your stocks, okay, your Googles, your Apples, and all that stuff. But when you have turbulence underneath the markets, okay, when you have turbulence underneath the markets, on the credit markets, with bond deals plunging, as we see, okay, as we see here, and all kinds of stuff, you start to get a pullback or risk off on the overall markets. On a tactical basis, we can show levels. But remember one thing, when panic takes effect, and I'm not saying it has, okay? But I'm saying when panic takes effect, emotional logic goes out the window. It's happened to our lives, but you got to think straight. That's the mark of a strong, focused, and successful trader. It doesn't mean you have to make money every day, but it means that you stay calm, you look at all the stuff that's happening out there, and you try to manage your book, even though it doesn't feel good, like on a day like Friday, with everything slipping and sliding. But the bottom line is we made some serious trade alerts and calls, which worked out tremendously as recently as Thursday afternoon. Okay, it's all there for everyone to see. Review the charts and the trade alerts and everything on my on my Twitter feed alert, and you all know that very well. The run up in Amazon, the run up in so many other things. Look at LinkedIn today. A few calls would basically make your month. Okay, forget about owning 30, 40 calls on this thing. Okay, these things happen. I believe that Twitter probably is the next thing. We don't know what's going to happen. Could be a month from now, could be 2 weeks from now. But I do know one thing from my years on Wall Street, that when you start to see this type of massive, large-scale headline buy on a large company like LinkedIn, from a company like Microsoft, it is sending a signal to the markets that it's okay to go out there and buy some choice property, which you need to buy on the cheap and develop. And Twitter is a prime example of that, in my opinion. Okay, could be Netflix, could be any one of these things. Anyway, let's take a look at what we are seeing here on the charts. We got 5 minutes to cover that, so let's start off with the E-minis. So here's a daily chart of the E-minis, and I'm going to take all these lines out or hide all the drawings. Okay, this is where we are. This is where we were. The double bottom, monster reversal. We got it. We were there. Okay, no one can take that away from Clueless Day Trading. And we staggered our way up with profits along the way. Never thought, I didn't think personally, that we were going to go back and hit 2100 within a matter of 2 months, but we did. Then we are having this corrective move here. Now, these are critical lines, and I want people to focus on them. Very, very important. On the E-mini specifically, because that's what happens behind the stage. Like I said, the market's like a kabuki theater, okay, or a Broadway show. But the kabuki theater is the one which is, there's a lot of like mystery and all kinds of weird stuff going on. So what happens backstage is important. Who's the next character that's going to show up, right? So these lines are extremely critical, okay? These lines are extremely critical. You have the 50 and you have the 34-day moving average, this orange line. When these lines start to cross down, and they haven't yet, they're flattening. So that's a warning sign, okay? They start to flatten down and they cross over. And if that's a convincing crossover, then I'll tell you, that's not a good thing. All right? That's not a good thing. That's it. In the meantime, what we are seeing is these highways, the 50 and the 34-day moving average. These highways are generally where the market tends to basically gravitate to. It's known as the reversion to mean reversion. When you move away too far away from the highways, you tend to go back up there. So see what happens. Look at it in a logical way. Let's keep all the noise of the market out there. We already know what the news is out there, okay? And all the negative talk and the positive talk and everything. So let's keep our mind straight here. So here we have. Let me get the drawing tool. Standard deviation. I've explained this clearly. I have talked about this extensively in my advanced coaching sessions, and members who have taken part in them know very well. The standard deviation from here to here was probably a +2. When you get a standard deviation like that, and you move away from the moving highways, keep it simple, all right, you tend to gravitate to, and touch the highway again. It's like driving along the road. This is a car. Let's say this is a car, okay? You're driving along the road, and then you take a twist and turn, and if you basically deviate too much away from the road and hit the grassy patch, you tend to get back on the road, right? And those are the moving averages, the road here. If you move too far away from the road and hit another pothole or a grassy patch or whatever, fall, you tend to get back on the road. So this is what the markets are doing. The standard deviation was, we moved away quite a bit. 2075, 2080 is basically where the markets normally travel in, and we moved away to 2125, which I predicted, okay, and took advantage of. And now we are back here. Is it possible that we slip below this? Yes, it is. And that's where we look at support level. Support level, the critical support level in the market on a critical aspect is 2025 or 2020 on the S&P. Call it 2030 on the S&P 500. Remember, on the E-minis, you got to add 6 or 7 points to it, or 5 or 6 points to it to arrive at the actual number for the S&P 500. So 2031 or 2025 is basically 2030 or maybe 2031 on the S&P 500. Is it possible we slip down there? Absolutely. This Brexit thing is serious stuff. So if we do that, then we have created a move like this, a wave like this. From this point, if Brexit doesn't happen, or some sort of, remember, the bulk of the fear is before, buy the rumor, sell the news, they say, okay? Or sell the rumor, buy the news. So the bottom line is that if Brexit happens or not, it's not like every other little European country is going to be checking out, saying, "Okay, see you later, you." Most of the fear and the damage will be done prior to that. So June 23rd is basically when Brexit is, right? I mean, the referendum is. So if we get down here, we will get a sharp reversal bounce, because at that point we will be at -2 or 3. We'll probably be at -3 or 4 standard deviation down here. So what happens again, as I explained? We're going to try to revert back to the mean. That's 2080. So this 2070, 2080 level on the markets is a critical number. Okay? And that's really what it is. In the meantime, this is what's really important is the stochastics. Deep oversold. Okay, looks like I got 20 minutes on this. Okay, so great. I thought I was running out of time. So we are in one single day, and this is what amazes me. Okay, I'm a technician. I'm learning every day. Okay, all of you guys are, and I'm learning too. So in one single day, in one single soup, we got oversold to a point I've seldom seen that. Once, okay, call it 2 days, right? 2 days of this red candles. Look at this. We are getting deep oversold. Now, we're not totally deep oversold yet in the sense that I'd like to see the green line here basically come down and test below the 20 level. Once you see this turn, and you can be a day or two early, but once you see this turn, you gotta buy. Or if these lines both come into the negative, sub 20 area, that's a buy signal. On a 24 to 40 hour basis, that is where most of the money's made. It's happened here. It's happened here. I can take you back all the way to the crash of October 2015, to what do you call, 2015. I can show you every single time. And I've talked about this extensively on a lot of my older videos. So bottom line is that this one's a little bit different in the sense that there was such heavy duty capitulation that we're almost 70% oversold in my opinion, maybe 80% oversold with a little bit more to go as the panic ensues, and then you're going to have a sharp turn. Now this is on the daily charts. On the hourly charts, um, you are or let's look at the 4 hour, which is the next thing next to the daily, closest thing to a daily. I also use the Darvas box, so people who attack traders, who I highly encourage, be tactical in this type of market. Keep your positions tight, don't go overweight on anything, and try to be flexible, or just don't trade and sit it out. But you'll miss out whatever happens if you sit it out. But that's just the way it is. It's a catch-22 situation. So at this point, McClellan oscillator is at minus 200, same as what we saw back on a couple of weeks back on what was it, Thursday, 2 weeks ago. McClellan oscillator gets towards this minus 200 level, or even the minus 300 level. Okay, these are buy points. Could slip a little bit more, could be minus 300. I use the Darvas box as a point of reference to see what's going on because look, I'm not a computer. I'm not a robot. I'm a fast thinker. I move fast, and I have a desire and persistence and diligence to survive and be hugely successful. That's why I'm doing this. So all of you should do that. So the way I look at it is I use the Darvas box as a point of reference, and you can see here on the Darvas box on the 4 hour. This is live e-minis that we're talking about, right? That it's starting to base around here. It doesn't mean it can slip and close this minor gap here. Well, I don't think we're going to go to 2040 today. Who knows? But our stocks are up, so what do we care? But this is a breakout line here. I've shown that on the charts, and that's around the 2070 level. Okay, and I think that should act as support. That's still 100 some points on the Dow, so don't freak out big time. I'm watching these McClellan oscillators at deep oversold conditions, Stows at deep oversold conditions, and every time it's come here over the next 24 to 48 hours, you get a reflex bounce. Can it be different this time? Absolutely. But you know what? We can live our lives moving forward looking at the rearview mirror, right? We can always say, oh, it's different this time. So what? We have to look at, we have to look at technical patterns. That's what we're looking at. Now, if this Darvas box is 2120 and the low is around 2070, let's say, or 2076 here, 2077, okay, on the E-minis, you can clearly see here the deviation from, in the 4 hour chart, from the standard deviation from the moving averages, 50 and the 34, is quite large. So is it possible that we basically bounce towards here and probably hit, let's say, get towards 2100 on the S&P? Absolutely. Will that be a sell point? Possibly, because there's a lot of nervousness in the market. In the meantime, study every single one of my charts that I put out there. Congratulations again on LinkedIn. Twitter is going to be on the move. We might get a bounce on Tesla today because nothing's been confirmed that they had suspension problems. Stock is quite oversold on a technical basis. And here's a quick chart of the S&P 500, and you can see here, same story. We're touching the 50 and the 34. Okay, 34. Thanks for listening. And this is Clueless A Trading.